You know that feeling when you check your bank account and your just stomach drops? Maybe it's Thursday and payday isn't until Friday, and you've got $4.17 sitting there, trying to hold the line until your direct deposit hits. Here's a fact nobody tells you. In that exact moment, when you're at your most vulnerable, the bank is making more money off you than they make off the millionaire with $2 million in savings. I know. It sounds backwards. It sounds impossible. But in 2026, America's largest banks generated over $15.47 billion in overdraft and non-sufficient fund fees only. And the customers paying those fees, they have an average account balance of less than $350. The system isn't broken. It's just working exactly as it was designed. While you're stressing about whether that coffee purchase is going to trigger a cascade of fees, there's a data scientist at Bank of America running algorithms specifically designed to maximize the damage. The bank doesn't want you to save, they want you to struggle, because your friction is their profit margin. Today, we're pulling back the curtain on the zero balance trap, the multi-billion-dollar business model that turns your empty bank account into their most valuable asset. I'm going to show you the math, I'm going to show you the tactics, and I'm going to show you how to escape. Welcome to the poverty tax.
Let me quickly paint you a picture. It's Monday morning. You've got $150 in your checking account. You stop for gas on the way to work, $25. You grab lunch, $12. After work, you pick up groceries, $43. On your way home, you remember you need laundry detergent, so you stop at Target, $18. Then you get home, check your banking app, and you're feeling okay. You spent $98. You've got $52 left. Tight, but manageable. But here's what you forgot. Your car insurance auto pay is set to run tonight, $175. In a fair world, here's what should happen. The insurance payment would attempt to process, it would be declined because you only have $52, and you'd get hit with one overdraft fee, typically $35. Total damage, you're negative $158. Not great, but at least it's predictable. But that's not what happens. Because at midnight, while you're sleeping, the bank's software runs a script. And that script has just one job, to maximize fee revenue. Here's how it all works. The bank holds all your transactions in a pending state throughout the day. Then, at the end of the business day, instead of processing them in the order you made them, chronologically, the way any reasonable person would expect, the algorithm reorders them, largest to smallest. So the $175 insurance payment clears first. Now you're at negative $25. Then the $43 grocery charge hits. That's overdraft number one. Now you're at negative $68 plus a $35 fee. You're at negative $103. Then the $25 gas charge, overdraft number two, another $35 fee, negative $163. And finally that $18 from Target, overdraft number three, another $35 fee, negative $216. And finally, that $12 lunch you bought at 1 p.m., the one that cleared when you had $125 in your account, overdraft number 4, another $35 fee. Now, you wake up Tuesday morning expecting to be negative $123. Instead, you're negative $263. 4 transactions that you made with available funds have now cost you $140 in penalties. The bank didn't lend you money, they didn't provide a service, they just rearranged the order of your life to extract maximum profit. And here's the kicker. This practice, transaction reordering, was so predatory that it sparked multiple class action lawsuits. Banks like Wells Fargo, Bank of America, and Chase paid out hundreds of millions in settlements. But did they stop doing it? Some scaled it back. Others just got more creative with the wording, because at the end of the day, the profit is too good to give up.
Okay, so maybe you're thinking, I'll just be more careful. I'll track every purchase. I won't overdraft. Great plan. The bank has already thought of that too. Let's enter the monthly maintenance fee. Let me introduce you to Sarah. Sarah here is a grad student. She works part-time at a bookstore, makes about $1,100 a month, and she's incredibly careful with money. She tracks every dollar. She hasn't overdrafted in 2 years. But every month, $12 disappears from her account. Why? Because her bank requires a $1,500 minimum daily balance to waive the monthly maintenance fee. And Sarah, despite doing everything right, hovers around $400 to $600 depending on the week. So every single month, the bank charges her $12 for the privilege of having an account. Let's do the math. Sarah has $400 in her account. It costs the bank approximately $0.03 per month to maintain her digital account records, but they charge her $12. That's a 40,000% markup. If Sarah can't build her balance up, that $12 fee will drain her entire $400 in about 33 months, even if she never spends a single dollar. The bank will successfully liquidate her savings just by waiting. Now here's the part that really stings. That $400 Sarah has sitting in her account, the bank is using it. They're lending it out. They're generating interest on it. It's part of their fractional reserve system. But when it's time to give Sarah a break on fees, suddenly $400 isn't enough. Suddenly she's a low-value customer. This is what economists call rational inattention. The banks are betting that you're too exhausted, too busy juggling work, bills, kids, life, to notice $12 slipping away every month. And they're betting that when you do notice, you'll feel ashamed, like it's your fault for not having $1,500 lying around. But it's not your fault. It's the design.
Now, let me tell you about this guy named Marcus. Marcus works in retail. He gets paid every 2 weeks via direct deposit. His rent is about $950, and it's due on the 1st of the month. Here's Marcus's situation. He gets paid on Friday the 2nd, but his rent auto pay is scheduled for Thursday the 1st because that's the due date and Marcus doesn't want a late fee. So on Wednesday, the day before rent is due, Marcus's employer processes payroll. Marcus opens his banking app on Wednesday night, and there it is, $1,247, still pending. He can see it. It's right there in his account. The money has left his employer's account, it's been transmitted, it's in the bank's system, but the bank won't release it until Friday. Thursday morning, Marcus's auto pay tries to process, and even though his $1,247 deposit is sitting in the bank's system, the bank marks it as unavailable. The rent payment bounces. Marcus gets hit with a $35 non-sufficient funds fee from the bank. His landlord hits him with a $75 late fee. Marcus just paid $110 in penalties for money the bank was already holding. So where was that $1,247 on Thursday? It was being used by the bank. This is called the float, and it works like this. When your paycheck is in pending status, the bank has already received that money, but they delay making it available to you, sometimes for 1 day, sometimes for 3 days, so they can lend it out overnight. They're making interest on your money while simultaneously charging you fees for not having access to it. In 2022, the Consumer Financial Protection Bureau found that the average hold time for direct deposits had increased at major banks, even though the actual electronic transfer happens almost instantaneously. Why? Because the longer they hold it, the more overnight interest they can extract. The bank makes money twice, once from the interest on your pending deposit, and again from the overdraft fee they charge you for the delay they created. And Marcus? Marcus now has to scramble to borrow money from a friend, skip meals, or take out a payday loan at 400% interest just to cover the fees the bank engineered.
Here's the truth they don't want you to know. The zero balance trap only works if you stay in the dark. The moment you start paying attention, the moment you start asking questions, you become an unprofitable customer. And that's exactly what you want to be. So here's your action plan that would possibly work. Step 1. Pull your last 3 months of bank statements. Highlight every fee, overdraft fees, maintenance fees, NSF fees. Add them up. You need to see the number, because once you see it, you can't unsee it. Step 2.
Research credit unions and online banks. Institutions like Ally Bank, Chime, and Navy Federal Credit Union have legally abolished overdraft fees. They don't reorder transactions. They don't charge you for having a low balance. They exist. They're FDIC insured, and the big banks are terrified of you finding them. Step 3. If switching banks feels overwhelming right now, at least opt out of overdraft protection. Yes, your card will get declined. Yes, it might be embarrassing, but a declined transaction costs you $0. An overdraft fee costs you $35. Choose dignity over extraction. You are not bad with money. You are not irresponsible. You are not the problem. You are navigating a system that has been deliberately engineered to profit from your vulnerability. The rent is too high, wages are too low, and the banks have turned that gap into a business model. But now you know, and knowledge is the first step to freedom. Tomorrow, we're going even deeper. We're talking about the credit score, the invisible number that controls your life. I'm going to show you why good credit is just code for profitable debtor, and how the system punishes you for paying off your debt too fast. Subscribe, hit the bell, share this with someone who needs to hear it. And this is the poverty tax.